George of the jungle, strong as he can be.
Okay, are you strapped in? Are you ready? Okay, I'm going to just kind of sum all of this up here. Again, this is part 4 of, I think I'm going to call this the last part of the video. I'm going to make a mention of some other stuff on here at the end of this one. But again, this is thecreditjungle.com, and what we're discussing here is an alternative method for leveraging your rates of return on investment property, putting down less money, not being a landlord, and getting a much greater rate of return than you would from typical rental property investment. So if you have not watched parts 1, 2, and 3, okay, this is just not going to make sense here. Okay, so what I want to do on this last part here is I want to address just a couple of things. This is going to be your equity position on this. And your equity position on this home here, had you just done this side of the equation, you have $100,000 of equity. Okay? On this transaction, but you've also got $100,000 worth of cash out of your pocket. On this one, you've got $45,000 worth of cash invested into it, but what's your equity position? Okay? Your equity position is the difference between what your option buyer or your seller finance buyer owes you and what do you owe the bank. Okay? So this is your equity position here is $95,000. And just to be clear, let's just say that this home went up $150,000 in the next 3 years. Okay? And now the home is going to be worth $650,000. Whose equity is that? It's not yours. Okay? This is the part that you are giving up, is this long-term appreciation for this. Okay, but hold on. Why did you buy rental property in the first place? Did you buy it for cash flow? Or did you just want to have a bunch of equity and then flip the property and sell them and do a bunch of 1031 exchanges? And if you want to do that, that's perfectly okay. Okay? But for those who are looking at this as I want to generate cash flow and I don't want the hassle of being a landlord, well, you've got to have some give and take here, okay? And part of the give is that any equity that accrues above their purchase price, their option price of $550,000, it belongs to the seller finance buyer. If they wanted to sell this home, okay, a year from now, and they can sell the home for $600,000, well, they only owe $495 on it, minus whatever principal reduction they've had on their contract, okay? So that's their money. And is that a bad thing? Well, no, because you've only put in $45,000 and you got back $95,000. So, I mean, you doubled your investment, they've doubled their investment, okay? It's a win-win scenario, okay? And the best business deals are always going to be where everyone wins. And this is identifying a need out there, and you, as an investor, filling a need that an institutional bank or a mortgage company is not willing to do, or they just can't do it, okay? So the benefit for you there is that. So let's just go and talk about this equity position here. What happens at the end of a year or at the end of 2 years or 5 years if the client decides that, well, I want to just pay it off. I've got a bunch of money, I'm going to pay it off, or I'm going to refinance because now I do qualify for a loan. And yes, they can refinance this contract without you transferring the title. Or they just decide that they want to sell it. But any one of these 3 scenarios are going to pay this off. Well, what do they owe and what do you owe? So now we're going to talk a little bit about an amortization curve here. Amortization curve has on the y-axis we have got money, and on the x-axis we have got time. Okay? So if 0% interest is a straight line, as the interest rate moves higher, this curve begins to bow out more. Okay? So if your loan is at 4 1/4, you are at a shallower curve than somebody who is at 6 3/4, because theirs is going to go and bow out a little bit more. If this interest rate was like 15%, I mean, it would just be way out here and then start a real precipitous decline after about 15 years. So at the end of year 1, your client now can refinance, or they want to sell, and they've got equity and they want to sell. Okay, great, that's fine. How much did you reduce the principal balance of your loan? Well, because you're at a lower interest rate, your principal balance is lower by $6,743. They've been making their payment for 12 months, but because it's at 6 3/4% interest, their principal balance has only gone down by $5,275. What? Okay, so wait a minute. So at the end of the year, I'm not just getting $95,000. I'm actually going to get an additional $1,400 on here. Yeah, you do. And for each year through the first 15 years on this curve, there is going to be a bonus equity in here where you are paying more money to principal than they are paying to principal. So that equity position continues to build up. Now, it's not a lot of money, okay, but it sure enhances your cash flow, and it certainly enhances your rate of return, because your cash flow isn't just $1,242 a month. You actually have to add another $120 to that. It's $1,362 a month in real dollars when this contract pays off. So that's pretty exciting stuff there, and I don't want to dive too deep, but there's some people that really get into the numbers, and I like numbers. I mean, I'm good at that. I'm not good at figuring out a lot of other things, but I can talk numbers. But this rate of return here, again, this is pretty much baked in the cake. This is a real rate of return on here, and just realize what the give and the take is on this one. If you don't want to give up what that future appreciation is, and if you want to have people in there that might trash the place and don't have a lot of money into it because you're betting on that appreciation for the value going up, okay, then this transaction, this isn't for you. You can just go buy it the traditional way and get the traditional rates of return. But anyway, this is something else to consider here, and then there's some tax implications on this that sunset in 2022. The Tax Cuts and Jobs Acts from 2018 had a provision in it for qualified real estate investors, and I'm just going to mention this briefly. You look it up. If you can hit that category as a qualified real estate investor, there is about a 25% depreciation charge you can take in year one that you own this home. So on this one, you'd be able to take about $120,000 of depreciation off of a $45,000 investment. If you're in a 30% tax bracket, basically this money right here is functioning as a tax credit, not a tax deduction. Okay, put that one into your financial calculator and now figure out your rate of return. But anyway, this equity position right here, I just want you to know that it starts out at $95,000, and during the course of the first at least 10 years and through the first 15 years, your equity in here is growing just a little bit because of this disparity between the amortization curves of a higher interest rate versus a lower interest rate. So hopefully that is really, really exciting for you guys. The one thing that I'm not going to talk about in this, and I will probably bring in Dave and Jax, and I'll do a separate video on what happens when the seller finance buyer defaults. Well, guess what? I'm okay with it, okay, and you would be too. But we're going to have Jax come in here and explain a little bit more about what are the default provisions in a seller finance contract. The good news is that it's not a foreclosure, and it doesn't take as long, and it doesn't cost as much money to be able to do it. So anyway, hopefully this was valuable information for you. Get you thinking about some different options to do this. Folks, I know for a fact there are a lot more people out here that have the 10% down and can afford this payment than there are the investors out here. So that's why I'm sharing this video. If somebody is interested in this and they want more information about it, push button, get Mortgage Professional. I'll be happy to talk with you about the mortgage side of this stuff, but I'm going to refer you to a real estate professional and to a real estate attorney for the aspects that I'm not qualified to talk about. But hopefully this is great information that might get you thinking a little bit differently about how you can become a real estate investor. So thanks for coming into thecreditjungle.com today. You have a great day, and I look forward to talking with you about your situation. Take care.